Hey everybody, thanks for joining us. Sunday, we're always here every Sunday at 1 p.m. Eastern, 10 a.m. Pacific. Love doing these live streams with everybody, kind of talking about a topic of the week and just really reaching out to all of you and talking back and forth. That's really what I get out of these is, that interaction that I usually don't get in videos and talking to you in the community. I got a lot of great stuff to talk about this week. Something that's probably one of the most highly requested live streams we've done. We do a ton of stock picking and talking about stocks and investing on the channel. And everybody always asks, how do I pick stocks? Come from a background as an equity analyst, almost 10 years as an equity analyst, working for venture capital firms and private wealth clients. Working through that charter financial analyst designation, that CFA designation, that's all about picking stocks and portfolio management and that. So I just wanted to use this live stream today to kind of guide you through kind of the basic process that I use to pick stocks, and kind of talk about some of the other techniques and strategies that are out there as well. See a lot of people from the community in. Greg, good to see you. Lydia Santiago got an investing channel as well. Check hers out. Lee Grennan, how are you? A lot of people from HK. Sunny Hing. HK, is that Hong Kong? Dennis from Texas. It's always amazes me how far and wide our community stretches here on Let's Talk Money. I myself am from Iowa, but live in Medellin, Colombia right now. So great city, fun, low cost of living, and we see people from all over the world actually. So welcome. Thank you for being here. Happy Sunday, Jay. But I want to get started and actually want to throw out one last request here for the. For my new book, called Crushing YouTube. This is the last day to get your 40% discount. Okay, just released this book, kind of documenting or chronicling my personal journey from 0 to 75,000 subscribers here on YouTube in less than 18 months. It's been a great journey. It's doubled my business income, and I really love how the book came out. If you want to support the channel, I really appreciate it. Those first initial buys on Amazon Kindle are what really helps rank it. So $2.99 if you want to support the channel. I appreciate it. It's a great book. Got a lot of great reviews so far, and I think it's really going to help those of you that are looking for that work from home income or that side hustle. But I want to get started, and I want to get into the topic for today because I'm excited. I always love talking about investing in stocks, and especially working through my process to pick stocks. So like we're going to start off with like we do every week, do some community shout outs. Love getting all the comments that I get in the videos each week, and love highlighting some of the best ones, some of the most thought-provoking ones. And honestly, I get a lot of my video ideas from these comments, video ideas, suggestions. So, anytime you want to see something for a video, you have a suggestion or just, want to share your opinion, go ahead and share those in the comments. I love seeing them, and I love, highlighting the best ones each week. Then we're going to highlight a couple of the videos from last week and a few of the videos coming up this next week, and then we're going to get into that process for picking stocks, and then of course we'll have question and answer at the end of the live stream. So thank you everybody for being here. I see, man, it just amazes me. Higher Elevation from Brooklyn. We got Anthony from Atlanta. Jay from Cherry Point. Cherry Point, is that are you in the military, or because I know there's air base there, as well as I think a Marine base too. But let's get started. You just get me started talking to everybody individually here, and we don't get anything done. So first comment I wanted to highlight this week was from Brandon. It was on a dividend video that we did last week or the week before on some of the risks of just looking at the payout ratio, right, or just looking at the dividend yield. And I actually covered this. Brandon talks about how not all dividend yields start out that way, and it's a lot of times it's a result of kind of a falling stock price. And I actually pointed that out as one of the dangers. So I don't know if Brandon saw that in there, but it's also still a great comment that I wanted to point out here, because I think so many people just look at that dividend yield when they're picking stocks. How much you're getting as a percentage. And kind of forget to look at what the stock price has done. And that's one of the big risks here, is that because your dividend yield is just the amount you make in the dividend, so the dividend payout divided by the stock price. Well, you could have a stock that is at a price of $100, pays a $2 dividend yield each year, or a $2 dividend payout each year. That's only a 2% yield. So nothing real exciting, nothing to get excited about. Now, if that stock price falls to $50, that dividend yield shoots up to 4%, because if it's still paying out the $2 per share, then $2 divided by 50 is now 4%. People rush into that to get that higher yield, and they forget to kind of look at the business fundamentals and why that stock price has fallen. So one of the dangers we discussed there. Check out those other two because they're really important. But yeah, there's two types of stocks for dividend yield. Really, the ones that start out higher dividend yields, some like your REITs, your MLPs. Those that just generally pay out a large portion of their profits as dividends, and then those that are made that way by bad management decisions and falling stock price. So again, great comment or great question there from Brandon. Next one we want to highlight here is from Streams Averse. Wants to see how you'd allocate a monthly addition of $2,000 to a dividend portfolio. He's asking, would you buy new stocks or ETFs, or buy more shares in existing stocks and ETFs? And this is a really smart question, because it's one that we haven't covered on the channel before, and one that you don't really think about too much when you're setting up that portfolio. You're buying into a portfolio. You got your portfolio set up, and then how do you do? What do you do with your new money that comes in? And it's one of the most important things to invest in. I always recommend is it's much more about what you put in. So those regular deposits, saving every month, and investing, rather than those big returns that you get. Okay, investing is nothing more than a really nice savings account. Okay, you might make 7, 10, even 12% average annual return on it, but even at that 7% annual return, over 30 years, or no, over 20 years, what you put in is still just as much as what you make. Okay, so it's not until 20 years that those returns on that portfolio start becoming more than what you put in. So of course, if you haven't been putting that money in, then it's not going to give it that chance to grow. But anyway, so do you buy new stocks and ETFs, or do you just keep putting money into the existing shares? And there's a couple of different thoughts on this. One is that once you get so many shares in your portfolio, and it's actually pretty low. It's if you get just a few ETFs that hold a few hundred shares each. So you're getting thousands of shares with just a few ETFs in there. You basically got the market a lot of times. I mean, unless they're very focused ETFs, like a sector ETF or some kind of a theme, then you're basically getting the market. So once you get so many ETFs and so many stocks in a portfolio, you're basically just going to get the market return. So if you're looking for a little bit higher return than the market, then yeah, you want to kind of limit what kind of exposure you have to stocks. And what I always recommend, of course, is the core satellite strategy, where you do have 3 or 4 ETFs that give you exposure to all the asset classes. Okay, so you've got a couple of stock ETFs that give you pretty broad exposure to the stock market. That's international and U.S. You've got a bond fund, which may be the BLV, the Vanguard BLV, which is a good bond fund, or the AGG. And then you've got a real estate fund, which may be the Vanguard VNQ. That's going to give you your overall exposure to these, to those asset classes, give you kind of a smooth ride to your portfolio. And then you add no more than really maybe about 10 stocks, 10 individual stocks. And what that's going to do, it's going to keep you from getting so diversified in your stocks that you just get the market return. But it's also going to give you, the chance to kind of beat the market, add, maybe 1% or 2. And really what we're talking about is not huge gains here. We're talking about maybe 30% of your total wealth in these 10 stocks. So even if you do really well on these individual names, you're only going to be adding maybe 1% or 2 or even 3 to your overall portfolio. But that's still a huge benefit, a huge upside over 20 or 30 years if you can book that. Okay, just 1% over compounded over 30 years adds up to hundreds of thousands of dollars. But what it also does is it cuts down on the time you need to be analyzing stocks, and that's what we'll talk about in today's live stream is the process for picking stocks and picking really good names. Picking names that have that upside potential. And it's not something that you're going to be able to do in just a weekend. Okay, this is a 5 hour a week or so job of actually picking stocks. That's what analysts do every week for 40 or 60 hours. So that core satellite process is really going to help you limit the amount of analysis you need to do and really stay focused while still getting those good market returns in that ETF part of your portfolio. So good question there. Now I want to move on to cover real quick what we covered last week in the videos, what we're going to cover next week in the videos, and then right into our topic. I see some questions coming in and I'm going to get to those as soon as we can. In the Tim wants to know, where's the bow tie? Sundays I got to relax, man. This is about as relaxed as I get in a shirt. So I take the bow tie off and I just sit around and talk with you all on the live stream here. But so getting into last week's videos, we started a kind of a YouTube series. Like I said, I started the YouTube channel, started really developing the channel as an asset and as a community in December 2017. And here we are, so less than 18 months later, 89, almost 90,000 people in the community. And it always amazes me how fast it's grown and how well it's done. So I kind of wanted to share that with everyone through the book and through these videos. So Friday was a YouTube video on how much YouTube actually pays. I did research in 24 different channels, seeing how much they got paid from YouTube and put it all together to give you those expectations, because I think that's one of the biggest things with starting a YouTube business is that people have these expectations, right, of they're going to be rich. Their 7-year-old is going to have his own toy channel, is going to be rich. They're going to get 100,000 subscribers in like a month, and it just doesn't happen. So one of the biggest things you need to do is just set your expectations and know what's possible and know how to succeed. So that's really what I tried to do with that video in the book. And then tomorrow's video actually is another YouTube video. 3 keys that I've used to build that from 0 to 75,000 in less than 18 months. So 0 to 80,000 or 90,000 now. So 3 things like branding and how to get more subscribers, how to get more views, things like that. That's coming up tomorrow. And then I think Wednesday we've got another an update to our passive income ideas video. One of the most popular videos on the channel so far. I think our passive income ideas video has about 350,000 views on it. So very popular on the channel. Love passive income ideas because who doesn't like making money while they sleep? So I'm updating that video, putting out a new video Wednesday. 7 different ways that you can use to really grow your monthly income, and a lot of these, like it says, passive income. So really, what you need to focus on is creating those assets, because nobody can handle 7 different income streams all at once if it's active income. So you really need to be putting together some of these income streams that you can set up, and then they're gonna generate income every month for you. So let's that's last week's videos and next week's. Again, love seeing any of the comments that you have on those, getting your feedback on the videos, if those are the topics you like and you want to see more of those, or if you don't like the topic or you don't want to watch the video, just click in and tell me that. Share your opinion, give me your feedback on what you want to see and what you did or didn't like about the videos. So let's get into this though. How I pick stocks for my own portfolio. And I've shared this, some of the factors, some of the ideas that I use in some of the videos, especially that dividend investing challenge that we've got going on that's actually still beating the market. It's doing about 26% so far for the year against the markets are right around 20%. And throughout that, I've tried to share kind of how I picked these dividend stocks for that portfolio. But I wanted to get a little bit deeper into my process and show you kind of what I look for and how to find stocks. Now, what you got to understand is there's really 2 ways people are picking stocks out there. You see a lot of these professional analysts on TV or on the web or with their guidance, and they have a completely different way of picking stocks. Okay, professional analysts have a universe of stocks they cover, and when I say universe, I'm saying very strictly limited to one industry or even one sector. Okay, generally an analyst will be hired by a brokerage firm to cover stocks within an industry in which they have deep professional experience. So they'll come from the tech space, or they'll come from consumer staples or consumer goods space, and they'll cover stocks in that. And why is this? Because they have deep professional knowledge of how that industry runs. What it takes to be successful for companies, which companies have the deepest moats and the best the best intellectual property and the best competitive advantages. And they'll only cover those stocks. Okay, they're not trying to cover all the sectors and all the industries. And it's a powerful idea. This is actually something that Peter Lynch really focused on and talked about when he said, invest in what you know. It wasn't about investing in just the things you buy, at the store and stuff. He was talking about the things professionally. Okay, a deep professional experience in that industry. And that doesn't necessarily mean you have to work in that industry, but it does help to, to focus on one specific industry, read everything you can about it, read all the analyst reports and the industry research and all that to really get a feel for those stocks. And so what you can do if you're using this strategy, then yeah, you can use that kind of that core satellite strategy to get a very broad, broad market exposure through those ETFs, through those funds, and then make those 5, maybe 10 stocks that you invest in individually from that industry. Okay, and it might only be 3 to 5 stocks you invest in if that's the only ones that you really feel good about within that industry. Okay, and what this is going to do is obviously, with that deep experience and that knowledge in that industry, then that's going to put you so far out ahead of all these other armchair investors that sit around trying to pick stocks from every single sector and every single industry, because you do have that deep knowledge and you know which companies are really primed to go higher. So that's one strategy for picking stocks. The other strategy, of course, is for individuals that are trying to build a diversified portfolio across lots of sectors and lots of industries. You do have to kind of be that generalist. Okay, you do have to kind of look for the best stocks in each sector. And this is another thing that we talk about a lot in the channel, or on the channel, and in the videos, is picking stocks from each sector. Okay, so if you're screening for dividend stocks, and this is a big one because people will go to a website and look for the highest dividend yield stocks, but they don't look for that across industries or across sectors. So what happens is they end up getting a portfolio filled with REITs and BDCs and MLPs and consumer staples and utility stocks, because those industries and those sectors tend to pay the highest dividend yields. Okay, well, what happens when rates start going up? So a lot of these industries are very rate sensitive. So when rates go up, then they're kind of bond proxies. So the share prices come down. So if your portfolio is very much overweight in those sectors and in those industries, your portfolio is not going to have a good day. Okay, maybe not even a good year or a couple of years. So what you want to do instead is, whenever you're looking for stocks for a diversified portfolio, then yeah, you want to look at it by sector or by industry. Okay, so some of the ideas that we'll talk about today and the filter or the stock screener that I'll show you on Morningstar is, you want to do, you want to look for higher sales and cash flows and stuff like that, but you want to do it like 8 or 9 times, and each time you focus on a different industry. Okay, so you're looking for the best of breed stocks in each industry. When you're filtering for stocks, that's going to give you that diversified portfolio of all the sectors, and it's really going to protect you from any one sector risk. Okay. So my process for getting stock ideas, getting investing ideas, it usually starts with a higher level top-down approach. Okay, now I'm going to talk about this, and I'm going to show you some of the websites that I use and that kind of thing. But top-down investing, okay, there's 2 types there: top-down and bottom-up. Okay, the bottom-up investing is what a lot of analysts do. Okay, since they're only looking at a handful of stocks in one industry, then they'll look at all the stocks, the individual companies, and they'll do a cash flow analysis of their cash flow statement and a financial statement analysis, and they'll do a bottom up on how much they think each company is going to make and what their stock price is worth. Okay, so they'll do an analysis of each company individually, and then they'll look at some of the higher level macroeconomic factors. Okay, and they'll kind of add that in or detract that from their individual stock analysis. Now, what I do and what you do in a top-down analysis, and I much more prefer this type because I think it's very much easier to get higher returns, to get better returns. It's very much easier when you're talking about limited time for analysis and research. But top-down investing is first looking at that big macro, that environment, that those big universal forces that are affecting all stocks and all industries, and then specific sectors. So with macro analysis, you're going to be looking at news headlines. You're going to be looking at the general economy, the global economy, trade, a lot of that thing to see kind of where things are going. Okay, so if the global economy is doing well, if the U.S. economy is doing well, then that's a positive. Then you come down and you look for ideas for specific sectors. Okay, so sectors of the economy: consumer staples, utilities, real estate, energy, technology, things like that, right? Those broad parts of the economy. And you start looking at factors that are affecting those. Okay, so interest rates is a good example. Are interest rates rising or falling over the next year? Okay, so that's going to give you an idea of the larger forces on each of these sectors. Okay, and what this does is you don't have to analyze 10 or 20 or 100 companies. Okay, if you're trying to pick stocks from the entire market, then you're obviously going to have to, if you're that bottom up an analyst, that you're looking just at specific companies, then where do you start? Where do you start with the 2,000, 3,000 stocks tradable in the market? With this top-down analysis, I can say, okay, the U.S. economy is doing well, but the global economy is struggling. Okay, so I want to focus on U.S. stocks. That narrows my list significantly. Okay, now U.S. stocks. Okay, Fed is talking about cutting rates, so that's going to be positive for a lot of these rate-sensitive stocks, not so much for maybe some of the other stocks. So that narrows my list down even more. And again, all this analysis, this is very easy to do because you're just looking at kind of headlines coming across as far as economic events and then other headlines. So you're narrowing your list down to specific sectors that you think are going to do really well. And then within those sectors, then you can start looking for those individual stocks. Those individual stocks. You can start looking for the individual industries in those sectors that are going to do well according to these big macro forces. Okay, and you can take that a step further and look at some of these large these universal forces that are developing over decades. Okay, we covered this in another video actually a couple months ago, stocks for the next 30 years, right? Forever stocks, I call them. And these are the universal forces that are developing over decades. Things like an aging demographic, things like the AI, things like self-driving cars, things like that, things that are going to be developing at least over the next 10 years and are really going to push specific sectors and specific industries. Okay, taking that top-down approach, it makes it very much easier to pick specific stocks because once you find an industry, a specific industry of products within a sector that is going to be driven by these large forces, you really don't even have to pick the very best stock in that industry, okay? Because all of these stocks are going to do well. If let's take an example, carry that example of self-driving cars and automation out a little bit further. So within that theme, you look at trucking companies. All right, probably about a third, 36% of their total costs are those driver costs. Okay. And so what happens when they need maybe half of the drivers because the long hauls, they've already got trucks, commercial trucks that can go coast to coast with no driver. Okay, so and that level 4 automation is maybe a year or two away, where they're actually doing that on a regular basis. So you look at the specific industry that is going to be able to cut a huge chunk of its income or of its expenses by half or more over the next few years. All the trucking companies are going to do well. It would be very hard not to do well in that environment, in that scenario. Okay, so once you find that those large macro forces that are driving one individual industry or sector, then you pick a few best of breed companies out of that sector, and you're going to do well. So that's really kind of the bird's eye view, I guess, of my process. So what I'll usually start with is, I'll usually start on some of the There we go. So some of the news sites, Bloomberg is probably my favorite, and they've since, over the last year, they've instituted kind of a subscription service, which I hate. So you usually can't get a lot of articles for free, and I don't know if I'd pay for the service, but here you can start, and I like Bloomberg. We'll look at CNBC also. I like Bloomberg though because it's a little bit more less sensational, a little less like stock picking, and more of that top-down approach and looking at the bigger picture and a lot of this stuff. So I'll just kind of scroll through Bloomberg each day and kind of look for the stories that might have that large top-down kind of idea. So of course, a lot of times you look for stories. The GDP reports give the Fed two problems. Okay, so very important right now is how many times the Fed is going to cut this this year. Markets actually expecting 3 cuts, which is, I think, highly unlikely. So anything that throws that market opinion off is going to be a really good article. So that one. So I'll just look at some of these. Facebook's $5 billion penalty is a little bit more specific. I try to stay away from some of the politically motivated stories because they're a little bit more sensational and not quite something that's actually going to affect the market, right? So I'll look through that, and then I'll go to something like CNBC, right, which is a little bit more stock picking, a little bit more sensational. They'll do a little bit more list posts and stuff like that, but they still do some good top-down analysis where you'll be able to find some ideas that that can give you picking top-down analysis ideas. Okay, again, you're not looking for stock picking ideas here because you want to do your own stock picking. Okay, you're just using those bigger ideas. So something like this: China's industrial profits fall in June, add to fears of a slowdown. So obviously, another big top-down risk in the market is how fast is China's economy slowing, and when that's going to stop, and what the government is going to do to stimulate the economy. Okay, if you can get in ahead of those stimulus measures, then that's typically been a very good time to get in. Electric vehicle production ramps up. Supply crunch for battery materials is looming. Another big idea over the next few years is some of those rare earth elements and some of these other elements that go into battery production, and where are we going to get the things for that. So I kind of start off on these two websites. I might start off on Morningstar as well, just looking for that. But then, another important point when you're stock picking, when you're talking about picking stocks and finding new investments, is just looking back at your portfolio. Okay, so I'll look back at my portfolio, and it makes it a little harder because I've got 6 different investing accounts on 6 different platforms. So you want to look at it a portfolio view. Okay, what do you have in your portfolio, and what do you need? Okay, so for example, we'll just look at our 2019 Dividend Stock Challenge portfolio right here. Okay, this is a portfolio of high yield dividend stocks. That's we're trying to kind of beat the market, trying to get a little bit higher yield this year, and it's doing really well. But we'll kind of look through here, and so typically of a dividend stock portfolio, we'll see a lot of consumer names. We've got financial here, a couple of China names, real estate here, but a lot of these are in the energy. You got an energy fund, financials, but a lot of these are consumer goods, financials, that kind of thing. We've got our bond fund, we've got our utility fund. What we don't have, obviously, is tech. Okay, and that's usually something that you don't have a whole lot of in a dividend portfolio. But again, when you're just looking at dividends, then you're going to be very much overexposed to one specific sector. Okay, and you don't want that in a diversified portfolio. So what I would start thinking is, okay, some of the news headlines that I read, some of the macro events that I've been seeing, and those large forces, how's that going to affect the tech space? Okay, and is now a good time to start adding a few tech stocks to my portfolio here to give me a little bit more diversification? Okay, so you always want to be thinking about your portfolio, a portfolio-wide framework. Okay, because even if all the signs in the economy said that consumer staples were going to be doing well, I don't necessarily want to add more consumer staples companies to this portfolio because because what if I'm wrong on that top-down analysis, or what if something changes in that environment? Then my portfolio is heavily exposed to these consumer staple companies, and I want to diversify that with a little bit more safety in some other sectors. So I've got my ideas here for which sectors I want to maybe focus on, and then I'll go over to Morningstar, okay, and great site to use for some research, stock analysis. I've actually got the premium membership on Morningstar. I think it's like $200 and a quarter, maybe $250 a year. Maybe actually a little bit higher, 400 or something. But I mean, I use it professionally, so it's a business expense, and I use that. The basic stock screener is good as well. But I'll go to the stock screener here, and you can kind of screen for some of those industries or sectors that you were looking at in that top-down analysis, or what you need in your portfolio, right? So I'll go here, and you can go down here to we'll just go to the tech stock sector. And stock sector equals, we'll go technology, okay? So go there. There's still 2080, okay? And now maybe I want a little bit larger companies. I don't want small cap or nano cap stocks that are going to be generally a little bit more risky. So I'll go market cap, which is the size of the all the shares times the share price. So kind of a proxy for company size. Greater than or equal to. Enter a value, and so generally large cap stocks are anything over maybe 5 billion in market cap, or usually a little bit more than that. Now I'll go maybe 3.5 billion here. So and that's going to further reduce 373. Now since it's for a dividend stock portfolio, then obviously I want a dividend yield of something. Even though so tech stocks don't traditionally pay a really high dividend, but I want to be looking for the best of breed dividend stocks within tech. So maybe I just set a 3% limit on this, or minimum on this, and that reduces my universe here to 28 stocks. Okay, so 28 stocks within the technology sector that have market cap of over 3.5 billion. So actually that's still a pretty small company in terms of stocks, and a dividend yield over 3%. Okay, and then I can go here and I can look at these, and what you want to be careful of is really kind of look through the industries and see if it's all the stocks in an industry are doing poorly, and so maybe their dividend yield is a little bit higher. You want to see what kind of industry exposures you got here, and then just kind of look through the list, right? And I mean, there's a lot of other things that I'll screen for, and we've talked about here on the channel, things like cash flow, things like cash flow growth versus net income growth. We actually covered, I think, 2 live streams ago, 2 weeks ago, we covered some of these basic fundamentals that I look for. So your operating margin, hugely important. Learn to love the operating margin, and it's super easy. It's just your operating income on that financial statement, right? On that financial statement, your operating income divided by your sales, that is the company's core profitability, okay? And that's something that you really need to be comparing when you're looking at these different stocks. The potential stock picks, you need to be comparing that operating margin. We'll look a little bit more into that. So you kind of go down the list, and I actually been looking at Western Digital lately. So I'll look at Western Digital here, and again in Morningstar I'll go here to financials, and a lot of stocks or a lot of websites, they'll provide their own analysis. Morningstar has its own analysts that do reports and stuff like that, but just learn the basics of some of these financial statements that we'll talk about, okay? Because you really do need to be responsible for your own analysis, know at least a basic idea of what's going on in these financial statements. And I'll tell you, if you're really serious about investing, and if you are picking your own stocks, then I mean, this is your money, and this is your retirement and your future financial goals. You really need to be serious enough to go to your library and get a copy of the one of the older editions of the CFA course books. Okay, that's the Charter Financial Analyst course books. It's a stack like that each year that we have to study to get the designation, and it's a 3-year test, one test each year. And it is the core of what financial analysts do, or what stock analysts do. Okay, you will learn so much in these. And again, if you're taking the program, it's like, man, it's like a few $100s for the books, but they always have copies in the libraries, older editions, and you can check those out for free and just read through, some of these ideas in stock analysis, because this is really what you need to be doing if you're going to be picking individual stocks. But here we are in, so every company releases quarterly and annually 3 financial statements here: the cash flow statement, balance sheet, and the income statement. Okay, so what you can do is there's some things that you'll want to look for in these, and I would say, so all stock analysts, they spend their ever-loving minds on the cash flow statement. Okay, that's really where the company shows you what it's doing and how it's doing. And that's actual cash coming in and out of the company. Okay, we'll look at the income statement. Everybody loves the income statement because it shows those earnings, shows those sales. Everybody talks about it, but there are so many ways to manipulate those earnings for financial shenanigans, and tips and tricks to move those earnings up and down wherever you need them. You can't fudge actual cash flow coming into the company. Okay, it's very hard to do. So analysts actually spend most of their time looking at this cash flow statement, looking at this, this net cash provided by, and that's operations. So this is actual operational cash flow. Okay, the actual cash coming in and out of the company on its business. Very important that you kind of look at this trend, where that operational cash flow is going, and then some of the things in here. You'll also want to look at things like debt. Very important to look at kind of the general trend in their debt. For Western Digital, it looks like they've been issuing. Okay, so paying back. So they issued a ton of debt here, $17.2 billion in 2016. I would imagine this is for a large acquisition they did. Paid back 5.3% of existing debt. But then these last 2 years, they've been paying off debt. Okay, only borrowed $8 billion that year, paid back 12, borrowed 14 this year, last year, and paid back 17. So I would imagine it's a big acquisition. It happened in 2016, and they're gradually trying to pay off that and get in a little bit better shape for debt. But that line there will tell you a lot of what you need to know, especially for value stocks, for deep value stocks that are getting in trouble. It's always the debt. It's always the debt that they owe and their commitments there. You want to look at that. You want to look at common stock repurchases, how they've been doing there, the dividends, that kind of thing. Another thing we'll look at is, I'll look at, is their balance sheet. Okay, and the balance sheet. So the cash flow is actual cash coming in and out of the company. All right. The balance sheet is one point in time. Okay, these other two, cash flow and the income statement, are over that entire period. So if they're reporting quarterly or if they're reporting annually, that's cash coming in annual over the whole year, income coming in over the whole year. The balance sheet is that one point in time. So a snapshot of the assets that they own, so all the cash they have, receivables, which are things they've sold and delivered on, but they haven't collected on it yet, inventories of stuff they've got, so all their current assets, their liabilities, which are things they need to pay, their long-term debt, that kind of thing, and then stockholders' equity, right, which is kind of the leftover. Okay, what they don't owe of their assets in their liabilities, that's what stockholders own. Okay, and some of the things you want to look at here is their total cash, as well as the total debt, the long-term debt, long trend in long-term debt that it's been going down, which is always a good sign. You want to look at whether their receivables have been going up, and a lot of this stuff, I don't want to get too far into the financial engineering or the financial the financial analysis of it. You can and you should get much further than this. You should, like I said, check out a few of those CFA charter holder books, the curriculum books. You'll learn how to look at these receivables and say, okay, well, just a minute. Are they extending too much credit to their suppliers or to their buyers? Okay, a lot of bad companies have been found out in the past by this receivables number, because what you'll see is that number will keep going up, and within their reports they'll talk about how they've been extending more credit and extending credit terms to their buyers. And it's kind of a clue that, okay, their buyers aren't in a great financial shape. So what's the idea? What's the odds, or what's the likelihood that they're actually going to collect some of these receivables? You find that out, and it's going to save you a lot of heartache before they have to take a write down of some of those receivables. Okay, a lot of companies, they'll get into trouble, and then they'll just it'll be baby in the bathwater quarter, right? They'll take a massive write down on these inventories, the receivables. A lot of that, the stock price will plunge. And it could have been avoided if you would have just looked at the receivables, the inventories also. If that's increasing quite a bit, then what's the likelihood they're actually going to make money on these inventories, that kind of thing. Like I said, I don't want to get too far into the financial analysis that goes on with these. We'll look at the income statement here, last income statement, and then we'll kind of get a couple of the other things that I look at to pick my stocks here. The income statement, again, it's the one that everybody focuses on, but maybe they shouldn't, because there are a lot of things you can fudge here. Even that top line revenue number, where you're looking at this actual sales made by the company, not always actual sales. A lot of companies, they'll book revenue that they haven't delivered on, or that they'll get maybe a 3-year contract or a multi-year contract. And maybe they'll book most of that right now. If they need more sales this quarter, if they need those numbers to look better, they'll book some of those sales that haven't really even happened yet. They're just kind of promised by a contract. Well, again, you see trouble here where they're booking sales, they're writing contracts with customers that probably aren't going to be around for 3 years, or aren't going to honor those contracts for 3 years. So it's just a way to fudge these numbers a little bit. But then you can also look at, like we've talked about, you can look at the profitability in some of these numbers. Okay, so you've got this cost of revenue, which is cost of goods sold, or it's the money that they pay for that raw materials and that kind of thing to produce what they do. And then you get this gross profit, right? So this gross profit divided by the revenue is their gross margin, what you'll hear a lot about. And that's just that's that first line of profitability. What I like to look at, though, is you take these operating expenses out. So these are the actual expenses to run the company, and then that gives you your operating income. Okay, again, very important. One of the most important metrics you want to look at when you're analyzing stocks, when you're picking stocks, is this operating income divided by revenue. Okay, don't let that divided by scare you. It's just 3832 divided by 2647. Okay, simple math. But one of the most powerful metrics you'll have in picking stocks, that's your operating margin, your operating profitability, the profitability of that company in its core business. Okay, it doesn't include some of these other things down a little bit lower, like interest expense, which is the leverage management is using. It doesn't include taxes and that kind of thing, which can also be kind of used to make a company look more profitable than it actually is. This actual profitability on the business. Okay, and so what you want to do is you find, so Western Digital here, 3832 divided by 20 billion gives you how profitable they are, and then you compare that against other companies in that industry, so direct competitors, peers within their industry, and you get a good idea of which management is doing the best job at being the most efficient and really turning those sales into operating income. Okay, so very important number. Can't stress that enough. And then, of course, you go down to the bottom line here, net income. That's what everybody looks at, those net income, earnings per share, when you divide that by the number of shares they put out. So earnings per share, also important, but like we've talked about, there are a lot of ways to financially engineer these numbers to get for management to get the numbers to come out the way they want, so they look more profitable. I'll go through these. Do my own financial analysis as far as looking at that operating income, that profitability. I'll look at the speed of cash flow growth versus net income growth that we've talked about here on the channel before, and I'll do that. Then I also want to look at the company's investor relations page. Okay, every company that has stocks has to have, by law, by regulation, they have to have an investor relations page, right? Some place that investors can go on their website and get these financial statements, get some of these other things. So I'll go here and I'll look for things like, usually I'll look for things like presentations. Okay, so I want to get management's perspective on the business, their guidance, that kind of thing. It doesn't look like Western Digital releases presentations for like analyst conferences, which are always good information, good stuff. But they do release quarterly presentations, right? So I'll download maybe the last quarterly presentation, kind of look through that, see what management is saying. Now, of course, you got to understand this is from management. They're going to paint the best picture they can on these on these reports, on these presentations. So you got to kind of take it with a grain of salt. You use it to to kind of temper some of your ideas that you got from that financial statement analysis. See if maybe management is highlighting one thing or the next. What you can do a lot of times, and this is kind of a secret tip of analysts, kind of a secret analyst trick that I always use, is you can kind of follow, for the stocks that you own and the stocks that you're really interested in, you follow their press releases, right? And you'll always see this on the investor relations page. You'll see something like press releases, okay? And you'll start to see these, and anytime management releases a press release talking about how well they've done in usually a specific part of the financial statements, so like maybe they've lowered inventories significantly, or their receivables are coming out better, or something like that, that's a red flag. Okay, that is the number one thing analysts look for in these press releases, is what is management highlighting, okay? Because they're telling you exactly where to look. Why are they highlighting that their inventories have come down so much? Well, was there a problem with their inventories, and is there maybe still kind of a problem with their inventories? How have they managed to get those inventories to come down? Are they a lot of times what you'll see is a company will have trouble selling, producing sales, so they'll build up those inventories, and then they'll release a press release that, okay, inventories, we've done so much better on getting rid of some of these inventories. So you'll see sales go up, but you'll see receivables go up too. So what they've done is they've just extended so much credit out to their buyers that the buyer said, well, hell, yeah, sure, I'll pick up some of this inventory from you. So always be looking at these press releases, because it's a red flag. It's a warning sign. It's what you need to be watching for in these financial statements. They're telling you what they're doing as far as these financial shenanigans a lot of times. And again, a lot of times, like we talked about with those receivables, are they extending too much credit, and are they actually ever going to collect on all those receivables? So it's just a one common trick that a lot of companies try to pull when they've been having trouble with sales, inventories have been building, then they'll shift it and only highlight that, oh, our inventory number is so much better now. Well, yeah. So I'll look at the investor relations page on a website. Then I'll go to some of my platforms, or the platforms that I use. So E-Trade, Bank of America, Merrill Lynch. I use those for a lot of research. I'll get Credit Suisse reports. So Credit Suisse analysts from E-Trade, Bank of America, Merrill Lynch has some pretty decent analysis, and I'll just kind of look at what other analysts are saying. Okay. Obviously, again, not trying to shift all the responsibility on those analysts, what they're saying. Okay, you need to be doing your own analysis and making your mind up. These are just, they're going to be pointing out things that maybe you missed, pointing out things to look for, that kind of thing. And again, a lot of this comes down to knowing what to look for in these three financial statements. Now, if this sounds like a lot of work, it is. Okay, again, this is what analysts, what equity analysts, what people like myself did. This is what we do 40, 60 hours a week, and even more, during quarterly earnings. That is a day on, stay on job right there. So it is a lot, and that's kind of why I recommend, only investing in maybe a handful, maybe 10 individual companies at the most. Again, you want to be in an industry where you want to be investing in an industry where you have deep professional knowledge. You know what some of these numbers mean, how much inventory or how much receivables typically a company in that industry has. Some of the you want to know the average for that operating income or operating profits within that industry, so you can compare stocks and you can say, okay, well, Western Digital has a looks like a 1.5% or maybe 15%. What was that? 3832 divided by 2647, 18% operating profit margin. Is that higher or lower than the average in that industry? You want to know that industry average, as well as some of the other individual stocks in there. So you limit the number of stocks you have to look at. You do that top-down analysis, so you limit it even further sometimes, and so you only have to analyze maybe 3 to 5 stocks each quarter or something like that, because this does take time. But again, this is this is the kind of analysis you need to be doing to get those market-beating returns. Okay, don't expect to be able to do none of the work while millions of people, analysts, their whole job, their livelihood depends on this analysis that they're doing. Don't expect to not have to do any work and then jump in, pick a few stocks, and be able to do any better than the market return. That's really where you need to be. So I know that's been a lot. I kind of rambled on because I love talking about picking stocks and analysis and that kind of thing. But I want to open it up to Q&A. If I missed your question here, I'm going to be scrolling back up and seeing what questions I missed there. What do I have? Again, I really appreciate if you want to support the channel. I don't usually ask for things like what's the thing that other YouTube channels ask for. It's like a cash bonus or something on these things, super chats or whatever. I don't ask for those, but if you want to support the channel, go to Amazon. Amazon Kindle, it's $2.99, so it's not a big purchase. But by crushing YouTube on Amazon, it's going to be the last day for that 40% discount. Just to trying to get that book to rank. It's already the #1 book in two of its categories. So I think podcasts and webcasts, and as well as auction and small business. #1 ranked, bestseller in those two categories. Got some great feedback on it so far. So look for that on there. Going back, trying to look for the question marks in the live chat. When should I sell? 38% increase from Mr. Young. Young One wants to know, when should I sell? 38% increase. Now, obviously, okay, if you're a short-term investor and you want to book that gain, then there's probably nothing wrong with that. But if you're a long-term investor, the thing is, when you're taking these profits in these stocks that you've got a great return on, and when you look back on that dividend stock portfolio that we've got, Hainesbrand, 80% return. Should we take that? Well, okay, if you're a short-term investor, if you're in a portfolio like that, we're just covering it for 1 year and trying to see where it goes, then yeah, maybe you want to take that. You want to go back to your analysis and see what a fair price for that stock is. A lot of that's going to return back to this analysis and what you think a fair price for that stock is. Stocks tend to fall further than they should and rise further than they should, obviously, just because of that herd mentality in the market. So, has it risen farther than it should according to your analysis? Now, as a long-term investor, though, you got to understand, if you're taking these these great gains every year, and that's great, that 38% increase in this 1 year or whatever, but what else are you going to invest in? And are you going to be able to find other stocks that are going to continuously beat the market and beat that stock picking kind of strategy? Because if not, then if your analysis says that's a great long-term company, has some significant advantages against its rivals, against its peers, then there's nothing wrong with holding it. Look at Amazon. It has been an outlier, outperformer for many years. Apple, okay, 25% annualized return over like 30 years. Okay, somebody might have looked at Apple in the in the 90s, seen a 30 or 40 or 50% return and said, okay, well, I'm out. And then 20 years, 2 decades worth of really strong returns they missed out on. So that really depends on what your strategy is there. What else do we have for questions? Greg, somebody's insights on living overseas. Okay, yeah. Greg wants to know about insights on living overseas, relation to financial tax issues. I came here originally to do business consulting around the free trade agreement here in Colombia in 2006. Loved it. Medellin is a city about the size of Chicago, so very metropolitan. All the amenities you'd expect from a large city like that, which is something I look for. Weather's around 80 degrees all year round. So I ended up meeting my wife while I was here. We went back to the States to work as an economist for the state of Iowa for a few years. Came back in 2013, and what I say a lot of times is, for a lot of people, living overseas, especially in some of these lower cost of living places, even if you're not going to do it for decades or for as long as you live, then if you do it for 3 to 5 years, you work here, you have your own online assets where you're making US dollars and stuff. It opens up so many doors. Okay, my wife actually just finished nursing school, so she hasn't worked for like 4 years, and we still save 90% of our income. Okay, 90% of our income every month we save, and I put that into my investments and real estate and other assets. And so when we do plan on moving back to the States, which we're thinking a couple more years, the door is pretty much wide open. We could live in any state, any city. I've had that chance to build my assets, build my online businesses up to where they support the family, even in a higher cost city. So something I think a lot of people should check out, even if you got kids. I know a lot of people that have moved down here with kids. As far as the financial and tax issues, yeah, that's a whole live stream that we'll have to get into. Any opinion? Jay wants to know opinions on cryptocurrencies. Actually, I don't cover cryptocurrencies a whole lot. I have covered Bitcoin occasionally on the site. First, calling it a supreme bubble back in end of 2017 when it was right around that $20,000 per Bitcoin. Talking about all the reasons why you don't want to invest. Then actually last year when it was down around 4,000, 5,000 a Bitcoin, talking about how it can be part of your portfolio. These kind of gambling or speculative investments like Bitcoin, like maybe some futures stuff that you want to look at, and having no more than maybe 5% of your portfolio in these. But you need to know, how to value them. And one of the things I always look for in Bitcoin and cryptocurrencies is something called Metcalfe's law, and it's actually I think it's a theory, maybe Metcalfe's theory. It's a theory on valuation in social network companies or stocks or investments, right? And it's been eerily accurate on predicting the stock price or the fair value price of a lot of these social networks like Facebook, Twitter, cryptocurrency. And basically, it's any asset that revolves around the usage by a network of users, okay? And cryptocurrency is very much a network of those users. And what's that worth? And it can actually give you a good estimate for kind of a floor value on Bitcoin. When we looked at it last year, I think it was right around $3,000 per Bitcoin, 3,500. So we talked about putting some money in there when it was right around 4,000 or 5,000, and subsequently it came back up to 10,000. I think that's where I sold out at that 10,000. Could go higher, but I'm not really much of a gambler. So I'm investing when it crashes down to that 3, 5, 6,000 range and getting out with that 50, 60% profit isn't bad. What other questions we have? If I miss your question here, please let me know. It takes about an hour to process these live streams. They'll go up on YouTube as a video. Ask your question in the comments. I answer every single comment I get. I love seeing the comments. So if I miss your question, just go ahead and ask it again in the comments, or look for some of the videos this week and ask your question. 940 shares. Are you single? No, I'm not. Sorry. 10 years married. Got 2 kids. We actually adopted a 3-year-old daughter here this last month. So spoken for. Sorry. Do you have any paid consulting or passive income sites? I don't do much private consulting anymore. I do like an hour of portfolio consulting for anyone in my stock investing course. But I don't do really any other paid consulting other than that. With this new YouTube course, I also do a portfolio or a channel review. Any of you interested in creating a YouTube channel, then I do a channel review and consulting on that as part of the course. But other than that, I really don't do a whole lot of the private stuff. Now, passive income sites, I do have one blog, a website called myworkfromhomemoney.com. That's where I share. I've got 4 blogs, but that's the one where I share all my ideas, my journey, building online assets, building online businesses, and passive income. So you'll find all that there. That's myworkfromhomemoney.com. And I believe you'll find a link to that on this Let's Talk Money channel as well. See a little matchmaking going on. Adriana and Eddie B. And so who else we got? What do you think about M1 Finance? M1, I love M1. I've been using it for about a year now. It's actually the platform, the free investing platform we've been using on for our dividend stock portfolio challenge. Actually, have a review, a free investing platform review coming out on. Let me make sure I get this. August 7th. So a couple weeks. I'm reviewing 3 investing platforms: Robinhood, M1 Finance, and Acorns, and kind of talking through each. And what I found when looking at these, I just started on Robinhood and Acorns myself. But what I found when looking at these is it's not so much which is the best, but which is the best for you. Okay, you always need to understand what kind of investor you are, and what you're looking for in a stock investing platform. Because Robinhood and M1 are great free investing platforms. You'll never pay a commission, you'll never pay a fee, but they're very much different as far as what they offer, investors, and what kind of investors they're best for. Okay, M1 only has that one trading window each day. So if you put in your order at 2 o'clock in the afternoon to buy shares, you're not going to get served on those shares until like the next morning when that trading window opens up. And that allows them to do those fractional shares, things like that. So you don't need that $2,000 to buy shares of Amazon, right? To buy a single share, you can buy fractional shares. So that's great, and that's great for the long-term investors and people that want a portfolio view. So I talk about that in there. Robinhood, a little bit more trading. You get that trade execution and some of the other things. So that one's coming out on the 7th, August 7th, analyzing those 3 platforms, and it's going to be a great one. What else we got? Eddie B wants to know, do I have Instagram? I do, but I suck at social media. Okay, I have not done anything with my Instagram account for quite a few months. Had somebody managing it. And honestly, I love YouTube, love talking to everybody here on YouTube. But as far as the other social platforms, I do a lot on Facebook because I've got for example, that YouTube, the YouTube book that I've got, Crushing YouTube, and the course with that. Then I've got a private group that I work with on Facebook that I interact with quite a bit and talk back and forth with them. But other than that, just getting on Facebook and Twitter and all that, it's just exhausting. So I don't do a whole lot. Actually, I need to hire a social media manager in the next few weeks to kind of manage all those accounts and kind of grow on those others. Without taking me off of YouTube here, because like I said, I love this interaction that I get right here on YouTube. What else do we have? I'm just kind of looking through for question marks. So if you asked a question but you didn't have a question mark on it, then ask it again, because I'm probably going to miss it. What else? And one of the things I love about these live streams is that you can get a conversation going just in the chat window. This is a community. That's one of the biggest things I've tried to grow the channel with is the idea that it is a community. We're all here to help each other out with ideas, suggestions, advice. And I love just coming on here and just interacting with everyone. So I love seeing that back and forth in the chat room there. Okay, Greg again wants to know any 10Ks you might study to get a different perspective on macro issues. Now, so 10Ks, like annual reports. Company. When we're looking at those financial statements, a company's going to issue, 2 kinds of those financial statements. Again, the 10Q, which is those quarterly reports every 3 months. The 10K, which is that annual report. Okay, and again, like he kind of points out here, that's going to cover a little bit more of that macro environment, that larger economic idea or business forces, because it is that annual report. Now, if you're looking for specific 10Ks for those macro issues, again, I would generally look for the news headlines and the overall economic reports that you'll see from Bloomberg and some of those things to find those larger universal forces. But that's actually a good idea too, is looking at some of these 10Ks, these companies, and them talking about those macro issues. So what you'll want to do is obviously look at companies that are a little bit more diversified. So generally you're going to be talking about larger conglomerate companies, maybe like things like GE, some of the industrial companies, that are going to be talking about that larger, broader economic environment. Okay, what you want to be careful of course, is, again, just like we looked at that investor relations page, this is coming from management, and they are going to paint the best picture they can for their company. So what you get a lot of times, especially with these quarterly reports and stuff, is you'll find kind of a complaint du jour. So you know what everybody's complaining about, why their earnings didn't come out as well as they wanted. Right now, it's, you know, tariffs, stronger dollar, things like that. So a lot of times you'll see companies blame, you know, the tariffs or stronger dollar or whatever this complaint is, and that's why, you know, supposedly that's why earnings or sales weren't as good as they thought. So you kind of got to take with a grain of salt some of these macro ideas that management points out. You know, you get what's, you know, really powerful is when you find a company that, despite some of these macro issues that other companies are raising, you know, management isn't bitching and complaining about these, you know, tariffs and dollar issues and things like that. They're performing, they're doing what they need to be done, and they're not, you know, kind of blaming other things. That's usually a sign of a good management. What else we have? Bloomberg TV, much more. Yeah, love Bloomberg. Managers not sell your trade to other brokers do. Lots of buffering. They're trying to stop YouTube teaching. What do you think? Okay, Okay, it looks like, okay, I'm just going to come down here to the bottom, towards the bottom of the chat. Okay. What do you think about Apple missing Q3? Apple, we just had somebody, okay, so who start team wanted to know about Apple, and actually Apple was last week, did a full analysis on Apple. You know, it's a great long-term company. There are a few risks that I pointed out. You'll want to watch that video because I did kind of point out that you probably want to wait a little bit for a better price. You know, the September product rollouts does look decent. I mean, it looks like we're going to get a pretty good line of iPhones, different iPhones, so that might help boost the stock a little bit. But you know, they're hurting in China. Their best designer has just left to start his own company. So a lot of risks in Apple right now. What else do we have? Wow, there are. Okay, I have a transcription for your top-down stock, and I know the book, but I'm not a beginner. Yeah, sorry, I don't usually do transcriptions for these live chats. That's Jose Mesa wants to know if I have a transcription for this top-down stock picking. I don't. For the live chats, I do have transcriptions and captioning for the other videos, but I don't usually for the live stream. What I can tell you is, again, I mean, you don't necessarily have to go to your library and take all the CFA books and study it like you're going to take the test, but just kind of cover some of those you know, some of those big ideas in the financial statement analysis. Okay, that's really the core part of the curriculum for the CFA is Chartered Financial Analyst designation. And that financial statement analysis, so FSA, it's a core part of that. I'd recommend reading a lot of the other parts of the books, but if you want that stock picking analysis, you know, look at that. They also have some macroeconomic and some economic focus chapters as well. And that's going to start you off on that top-down analysis. Okay, so that's really where you want to start with that. All right, so we are heading on over an hour here. I want to thank everybody again. If I didn't get to your question, I'm sorry. I get caught up in the topic and looking through the live chat here. Love talking to everybody here. If I didn't get to your question though, then please ask it in the comments to the video when the video is processed. If you don't want to wait for the video to be processed and go on YouTube, then you can just go to one of the other videos, ask your question there. I answer all my comments, all the questions there. I do appreciate it. Was things I have VNQ just wondering any benefits or disadvantages of VGSIX instead of I have more money to invest. Okay, Jennifer G wants to know about VNQ versus the benefits or advantages of holding that VGSIX portfolio instead of VNQ or in coordination with the VNQ. I want to cover that question because Jennifer's a great member of the community, been a member of the community for a while, and I really appreciate it. So yeah, are you asking whether you should pick the VGSIX fund instead of VNQ or along with it? Now generally, so Vanguard has a lot of these like Admiral Shares funds and other funds that are pretty much the same thing as their ETFs. Personally, honestly, I've never seen a lot of the benefit to whether you go with the Admiral funds or the ETFs. And maybe correct me if you're wrong what you see in some of these Admiral funds. I think they do come with maybe lower expense ratio, some of them. So VGSIX. And this is the Vanguard Real Estate Index Fund Investor Shares. It's got a yield of 3.9%. I'm not seeing the expense ratio. Expense ratio 0.26%. And now let's look at the VNQ. So VNQ 3.5% yield, so a little bit lower, but the expense ratio is only 0.12%. So ETF versus corresponding mutual fund. Yeah. Now, if you're talking about a mutual fund, I hate mutual funds, honestly. Unless you're forced into a mutual fund by your 401k provider, then I am all ETFs outside of a 401k. Mutual funds, they have higher fees, like we saw in that VGSIX, higher expense ratio because of some of the costs. They're not tax efficient. So a lot of the trading that the manager does in a mutual fund is taxed in that year. So they'll pass on some of those taxes to you. Whereas an ETF, the whatever trading they do in the fund isn't taxed to you personally. So generally, mutual funds versus ETFs, I would stick with the ETFs. Okay, unless you see much lower expenses in that mutual fund as far as like an expense ratio. Be on the lookout for any other fees mutual funds like to charge, like load fees, that kind of thing. Vanguard usually don't have a problem with that, but I would generally just stick with the ETFs. And what you can do, of course, is just compare the portfolios. Every mutual fund and every ETF, it's going to give you kind of a breakdown of the investments by sector, by industry, by country, whatever the theme is. And you kind of look at that and see, okay, which is the most diversified, which is a little bit safer, for that real estate fund. The VNQ, it's all U.S. companies, so maybe you want some international real estate exposure as well. I think it's pretty well. I haven't looked at the actual portfolio for a while, but it's pretty well diversified. So it's generally all you need, I'd say, for your real estate exposure. Maybe you put on a few more REITs. As well, individual REITs, but I generally like the VNQ. So again, I appreciate everyone coming out here. I'm going to take off because I got to get to the gym for my shoulders routine. I appreciate it though. Leave your comments in the in the comments or your questions in the comments to the video. I get to all the comments, and again, I appreciate it. Check out those videos coming up this week, and I will see you next week. Thank you.